Well, thanks very much, first of all, for having me. As Chris mentioned, I've been started writing the wiretap column in the Mercury News back in the dot-com heyday of 2000, and after a hiatus of several years during which I was covering politics and government and nasty things like that, I have come back onto the beat. The column comes out every Thursday in the Mercury News, and so this is obviously a very exciting time to be covering venture capital and startups again. Gentlemen here on my left, let me just pull out my cheat sheets real quick. We have Bill Reichert from, so I don't know who they are, from Garage Technology Ventures. Bill has more than 20 years of experience as an entrepreneur and operating executive. Prior to joining Garage in 1998, he was a co-founder or senior executive in companies including Trademark Software and the Learning Company. He's also worked for McKinsey & Company. Any recovering management consultants here in the audience? And the World Bank, and he unfortunately earned a BA at Harvard College, but an MBA from Stanford, so that raises the curve a little bit. And he was, in fact, a charter member of SVASC. So, Bill, thanks very much for joining us.
Well, I appreciate that introduction.
And then we have John O'Farrell, who's a general partner at Andreessen Horowitz, the venerable Andreessen Horowitz, which, as we all know, is shaken up the venture capital world in Silicon Valley and elsewhere in just a scant couple of years. John has spent about half of his 30-year career at a trio of high-growth startups that you may have heard of, including At Home Network, where he ran the international business, and LoudCloud, which I remember when it first came onto the scene, and now, of course, the cloud is absolutely the hottest trend in computing, and he worked with a couple of guys there named Mark Andreessen and Ben Horowitz, who he works with now at Andreessen Horowitz. John helped negotiate the sale of LoudCloud, which by that time was Opsware, to Hewlett-Packard in 2007 for a mere $1.6 billion. And he then went to Silver Spring Networks, another very exciting local company, and finally decided, what the heck, I'll give venture capital a try. How hard can it be? John is originally from Dublin, Ireland. We were just speaking about that a few moments ago, he and I, since I have Irish ancestry. But he also speaks Portuguese, German, and French. So feel free to just, sail forth with any language you might like. We will go ahead and jump in while we're waiting for Jeff Clavier, hopefully, to join us. The topic today is the changing venture capital landscape, and VC, as we all know, is, and I use that term probably too loosely, but when I'm talking about early stage funding, I'm talking about the environment for venture firms, private equity, angel investors. It's changed an awful lot in a couple of years. I know that when I first came aboard and moved to the Valley in 1998, you had pretty much your Sand Hill Road hierarchy, and angels were out there in to some degree. But if you look at where things are now, John, your firm has $1.2 billion roughly under management, again, in less than 2 years. You guys are certainly leading the trend. A lot of other more established venture firms have followed of getting into companies later and even through the secondary markets if necessary to get into the companies that you want to be in. And now we're starting to see more of the traditional firms follow that. I've had some people say to me, as they've looked at the model that Andreessen Horowitz has been using of getting into these later stage companies at higher valuations, as one Sand Hill Road veteran said to me, well, that's not venture capital. I don't know what it is, and I'm not saying it's not going to work, but that's not venture capital. Meanwhile, Bill, your firm has been kind of one of the original mavericks with VC. I remember when I again started covering the Valley, and Guy Kawasaki was at the time it was Garage.com, now it's Garage Technology Ventures. You said to me recently, your business model has been to kind of to go where the others aren't. So, John, maybe you should start on this. What changes? What's enabling these changes in the technology investment landscape, where a firm, even with some very established operating executives, can come in and raise gobs of money and really have all the other traditional firms sort of looking over their shoulders, if not trying to play catch up?
Well, I don't think we'd claim exclusive credit for that by any means. I think there are major changes going on in the landscape in general, and we're to some extent taking advantage of those, and to some extent participating in them and helping them drive them. Going back to the earlier comment, I don't know what it is, but it's not venture capital. I don't know if it's venture capital or not. I don't think it matters that much to us what the definition is, as long as it works for the companies we work with and for our investors. And I'd say our fundamental belief is that we're much less interested in investing in themes or trends or particular categories within a broad category that we call computer science than we are in investing in great companies. And we believe that great companies, there are a few great companies that get founded every year, 10 to 15 perhaps, that the research shows go on to create more than 90% of all the value of all companies created that year. And so, and go on to have a phenomenal impact on the world. And so nobody's going to be smart enough or lucky enough to get involved with all of those companies at inception. And our philosophy is very much, we want to work with those companies at whatever stage it makes sense to work with them, at whether it's angel stage, seed stage, whether it's venture stage, or whether it's late stage, growth stage. Because companies have very similar needs. They have different needs, but they have some similar needs throughout. They need capital. They also need great people. They need experience. They need connections. And a good firm, a good venture firm, can provide those at all stages, not just at very early stage or the classic venture stage. So I'd say that's the philosophy that's really motivating us. It's not unique to us, but we're perhaps taking a different spin on it than firms did before, and maybe getting some imitators in the process. But imitation is the sincerest form of flattery, as they say. So we'll take that any day. But we're participating as well as leading.
Bill, Garage, sort of as I alluded to, kind of was one of the
renegades.
Yeah, exactly. Thank you. One of the early renegades in this. So tell me a little bit about what you've seen the arc look like from the time that you guys were first starting the fund to where you are today.
Yeah. I mean, it's been a pretty wild 10 years. We started out in the sort of the late stage of the bubble, and the reason we got started was that we had come from a variety of entrepreneurial backgrounds and saw that the entrepreneur venture world was changing pretty dramatically. Actually, it was Craig Johnson of Venture Law Group, great man, who was the godfather of Garage, who saw that there was in the late 90s a tremendous shift in the evolution of venture capital, and it had gone from a relatively straightforward club to a global phenomenon. And our thesis when we started Garage was that the next big thing was entrepreneurship, and that entrepreneurship was a national and global phenomenon, and that the best way to find the most exciting startup companies was to cast the net broadly, literally globally, to try to find entrepreneurs wherever they were dreaming up great new ideas with great new technologies and try to bring them into the funding stream. And so our approach was really much more from the entrepreneur side. When we started Garage, one of our mantras was, we take the FU out of funding.
I don't think I can put that in the paper.
Yeah. I know, we didn't put it on our website either, but nevertheless, it was, that was the idea, that there were entrepreneurs springing up all over the world, and we, less as investors and more as partners in entrepreneurship, wanted to find the best entrepreneurs and help them avoid all the mistakes that we made as entrepreneurs earlier in our careers. And then through our network of relations with the venture community, help them get the funding, get the support, get all the help that they needed to build great companies. And so that's, that was the approach we've taken. That's the approach we continue to take to this day. We refer to ourselves as a seed fund. When we started, that was a bad phrase. Seed was not kind of real venture capital. It was sort of more associated with the angel part of the world. Real men didn't do seed. I don't know. It was very kind of, a funny part of the ecosystem. It's interesting now that for a whole bunch of reasons we can talk about, seed is the hot spot in venture now. And in fact, to some extent, we've been hoping that we could actually, to your point about John's firm, we've been hoping we could just kind of wipe out the phrase venture capital and start all over again, because right now the LP community hates venture capital. So the big institutional guys don't like venture capital. It's all the other players in the ecosystem that are generating all the energy right now in terms of what we call the super angels. I'll channel my Jeff Clavier for, a second here, in terms of, so many companies now, what they really need is a little bit of help right at that startup stage. And God bless that they migrate up into the big times and have the potential for becoming one of the few multi-billion-dollar companies a year that get started. That's great. But in terms of, sort of where you have to make lots and lots and lots of bets and lots and lots and lots of plays down at the seed level, that's where, we need the energy and the money and the talent, to help get these things started so that, again, with good luck and good fortune, they can migrate up to, getting a chunk of money and a multi-billion-dollar exit.
Right. Well, it's interesting. You hit on some really interesting themes that I'm certainly seeing emerging. Obviously, the angels, once again, in this kind of supercharged kind of way. Back when I started doing this in the late 90s, it was unheard of, the idea that angel investors would actually be able to actively compete with traditional venture firms for deals. I mean, they were two entirely different kinds of animals. But now I'm actually seeing and reading about and hearing about some competition that sort of breaks out as each side kind of pitches why it's the better choice for the early stage entrepreneur. A couple of data points that I have been gathering and noticing that were interesting. First of all, a year ago, the first quarter of last year, the average seed deal from a invested by a venture capital firm, according to the NVCA, was $6.8 million. The first quarter of this year, the average seed round from a venture firm was $2.1 million. So less than a third. So to your point, there's there's a need for seed investment. I mean, we could, within a mile and a half of where we're sitting, there are dozens and dozens and dozens of companies, and many of which are actually going to have the potential to become real companies, and yet less traditional venture money is going into that. The same token, as you alluded to, the sort of reluctance on the part of limited partners, the NVCA reported earlier this year that in 2010, the venture industry raised less money from its limited partners than they had in any year since 2003. So at the same time, there's finally a real emergence and excitement around early stage companies and real technology and real business models being created. Limiteds, as you alluded to, are a little bit nervous about that. John, do you think that it matters that traditional VCs are putting less money into early stage if the angels and super angels are there to pick up the slack, or do you agree that with some who would say that there are just real operational advantages that a venture firm can bring that an angel investor can't, let's say?
I think it really goes back to the companies that are, to me, it goes back to if you're investing at angel stage, you're presumably investing, or seed stage, you're presumably investing because you believe that company can make it significantly bigger than they are today. Otherwise, why invest, right? So there's definitely an enormous opportunity and a need for very active angel investors like Bill and like ourselves, for that matter. I should clarify that we've probably made 60 investments or so far, and well over half of those are seed investments. So we're extremely active. We'll invest anything from 50,000 to 100 million, and we've done both ends repeatedly. So I would say the classic venture firms, the traditional venture firms, do have a problem, or have had a problem, in terms of being very effective at the seed stage, though, because the classic venture firm model is you have a collection of general partners, you get a management fee from your fund, so you raise $1 billion, you take a 2.5% management fee, which is $25 million a year. If you have 5 partners, you probably pay each of the partners $4 million, and you take the rest to pay for some nice office, $4 million each, and a year, and you take the rest and pay for some nice offices and some good-looking admin staff, and that's about it.
God, I knew we were doing something wrong. Jeez.
So are we in that respect. So,
sorry.
But if you think about that as an entrepreneur, or indeed as a limited partner, whether the general partners of the venture firm that you're working with make $4 million a year or $400,000 a year or $40,000 a year for that matter, doesn't really change their value to you. It doesn't change their value to you as an entrepreneur specifically. So our view was that you could do a lot more with that money that's coming in from your limited partners, give them a lot more value, and give your portfolio companies that you're working with a lot more value. So we believe it's very important to have very experienced general partners that can work with companies from the very early stage, seed stage, right through to late stage. So very experienced entrepreneurs who've done it before themselves and, as Bill said, can really share and avoid the mistakes that we made, at least some of them. But also that you could take the money that you're getting from your limited partners and invest in value-added functions for the firm. So what does a company that you're starting, whether it's at seed or venture or even late-stage, growth stage need? They need people. They need experienced engineers. They need college talent. They need executives over time as they scale their team. They need CFO or a VP of engineering or VP of marketing. And rather than you relying just on one individual partner at a venture firm and that individual's connections and experience and indeed time to work with you, they're probably on 9 or 10 other boards. Why not be able to rely on that individual plus a firm that has people dedicated to those things and only do that for a living, or really experienced at recruiting the best talent, or PR, or sales enablement, or marketing, or business development, or whatever. So I think that's where the traditional firms maybe have struggled to work effectively at the seed stage, and that's where we've tried to do it a bit differently and maybe emulate, that what we've seen firms like Garage do very, very well. But also be able to scale then as a company grows beyond seed stage, to be able to say to them, you don't have to go and work with somebody else because we can work with you throughout. We have a multi-stage fund. We can write a big check as well as a small one. And we have functions and people who've worked at all stages right through to big public companies. And so that's really the theory, and I think that's where the traditional firms are perhaps having a little more trouble with that model. It's hard, and I'll stop on this theme in a second, but it's one more point on it, I guess. As you can see, I get pretty exercised on this topic. It's hard if you're a firm of, say, 5 or 6 partners, each making a hell of a lot of money, and you have minimal other costs, to say we're all going to take an 80% pay cut and start investing in value-added functions for our entrepreneurs. It's just a very hard thing to change that model once you've got into it. And so I think that's where the traditional firms are struggling. That's why new firms, as well as some firms who did it right from the beginning, are prospering.
So all the general partners at Andreessen Horowitz make $40,000 a year?
I won't give you the exact number, but it's certainly not millions and millions.
Bill, talk a little bit about that, where you sort of see the traditional venture industry being, especially the point you brought up before, vis-a-vis limited partners.
Well, first of all, with regard to the numbers you quoted from the NVCA, with all due respect to my dear friends at the NVCA, I don't trust their numbers at all when it comes to what's really going on in the venture community. They sometimes they seem to have the trend right, but the numbers you quoted just don't make any sense. So, the reality is that there's so much going on at the angel, seed, entrepreneur level that isn't seen in these various, research reports and numbers.
I don't think they were saying that money's not going into seed.
Yeah.
I think they were saying that the traditional venture firms are focused much more on the companies that are closer to exit and leaving the seed stage to the angels and super angels and some of the maverick funds, as we might be.
Well, and I think if you just measure the dollars, I think it's probably true that in sheer dollars, venture has shifted a little later for a couple of reasons. Their portfolios are getting older, and there's a perception that the returns are more assured in some later stage plays, and more money's been raised in the later stage. And then you get new guys like John's firm who are doing a sort of a barbell play, and that's sort of one of the new, I don't know if it's a new buzzword, but it's one of the buzzwords, is barbell, right? You invest early, you invest late, and that's a good way to invest. But I do see, just generally, for the sake of entrepreneurs generally, it's the venture community, I think, broadly is extremely challenged at the early stage, and because of less LP money going in, the LP money that's going in tends to be going later. So there's definitely less money available from traditional venture, plus angel at the early stage for most sectors of technology. There's this bubble in social local mobile gaming that we're seeing, and there's a lot of particularly angel money and now increasingly venture money flowing into that sector, but that skews everything up. And if you look sort of across technology sectors, generally it's really tough. Generally it's really tough out there. And so, but having said all that, every single one of my friends in the venture community is also doing seed. I mean, I don't think there's a brand name firm out there that doesn't say, oh yeah, we just put 200,000 into a company or whatever. I mean, so everybody wants to keep playing in the seed stage because frequently it's because they're backing an entrepreneur that they've already won with, and that therefore excludes a lot of new entrepreneurs, and so that doesn't help you if you're a first-time entrepreneur. But even increasingly some first-time entrepreneurs, VCs will come across a team that they fall in love with that doesn't have revenues yet, and their partners will give them a silver bullet, and they'll get to put a seed investment in. So you're seeing all of the firms still playing in the seed space, but just in terms of the allocation of money, it's getting distributed more thinly, I would say.
Do you guys worry, given the fact that there is so much attention focused on those specific sectors that you mentioned, not only in the investment community, but frankly in people that the media and the general populace, that all these other entrepreneurs who are in other spaces are maybe getting starved a bit for capital? John?
I think it is a concern. I think particularly space. So we invest in what we understand. We invest in where our backgrounds are in enterprise IT and in consumer software, consumer internet, which is why we invest there. It's not a specific preference for those sectors. It's just where we believe we can add value. But I would say it's significantly easier to get funding in the consumer space for most firms than it is to get funding in the enterprise space, for example. We're very, very active in enterprise, by the way. About half of our investments, both number of investments and dollars, are in enterprise IT. But I would say go beyond that to semiconductors or biotech, for example, or materials, even clean tech, which I came out of. I've spent several years in before coming here. I think it's a lot harder to get funding than it is in consumer specifically. And I think that is concerning in terms of the economy and the world over time, certainly U.S. competitiveness over time.
I mean, in the grand scheme of things, it's even in social local mobile, it's never been easy for an entrepreneur to raise money. I mean, and it's still a tough job. It's tougher in some sectors. But it's still, fortunately it's still going on, and fortunately innovation is increasingly global. So in terms of the grand scheme of, do we face an innovation gap? Is there a problem? I'm not that worried about an innovation gap. I am worried, though, about the degree to which it happens in the United States, and to the degree to which it happens sort of within the U.S. venture community, which will be the basis for more and more money coming back into the venture community and recycling it. So, success in the U.S. venture community is in all of our interests, even if you're coming from Denmark or France or New Zealand, because it is the primary source of funds for venture globally. And so it's, the more success we can have, the better. And I worry that by distributing too much of the success into too few pockets, long term, we might starve out some sectors that we wish we hadn't.
Another model that has sprung up in a way that was around a decade or so ago, but has now been refined and is hotter than it even was back then, is this whole notion of incubators or accelerators. Y Combinator being the one that sort of leapt to the forefront. 500 startups, which Dave McClure is doing here in town. Ad infinitum, it seems like every time I turn around, there's a new one. I wrote about one 2 weeks ago that's just focusing on clean tech. There's one that's just focusing on healthcare plays. Does that work? I mean, can you build startups on an assembly line, basically? I mean, obviously the idea back then, and I think now too, is look, you come and start the company, and we'll give you the stuff that you need in terms of the tools to make it happen, and you won't have to worry about finding an admin or paying the lights and these kinds of things. It seems that every single one of them has a different model in terms of what percentage of your company they're going to take and how much of money they're going to give you. And you know, John, you're smiling, so you obviously have thoughts about it. So why don't I shut up and you tell me what you think?
I don't know. I think certainly there are functions I think that can be very valuable to a startup entrepreneur. But to me, if you're really convinced that you've got something and you're passionate about it and you want funding for it and you believe you can really change the world and build a really significant company, there's no way, if I were in your shoes, that I'd give up equity for office space or for legal services or help in finding an admin or whatever the example might be. Those are totally commodity fungible things. And yeah, it might take you a little time, but it's actually your job as an entrepreneur to find those things and build your company in all respects, I would say. The last thing you want, I think, is training wheels. You want to be thrown into the world, and in my experience at least, and survive and show you can do it. There are things that can really accelerate you, and they're not around office space or legal services or whatever. They're people, for example. I mean, you know, getting access to great talent, getting access to experience, as Bill said, you know, people who've done it before and can help you avoid some of the mistakes. People who can give you connections, people who can help you build an enterprise sales force if you're an enterprise software company, for example, and so on. And those are things that incubators, I think, typically won't give you as much of, or it's harder for them to do in many cases. But a firm that's invested in those things can do more effectively if they've dedicated staff to those. I wouldn't by any means, though, I'm not in any way writing off Y Incubator or any Y Combinator or any of the other incubators. They do provide some valuable functions in terms of experience and access to like-minded people and the ability to work with other entrepreneurs and share experiences. But I would say if you're really trading off equity for anything, you really got to think about that hard. And if you're building a dependence on a firm or an incubator or anything else for things that you really should be building as core capabilities in your own company, you should think hard about that as well, because it's only going to hurt you over time.
But what are your thoughts?
Yeah, well, as my partner Guy Kawasaki likes to say, let 1,000 flowers bloom. Actually, that was Chairman Mao who said that, but Guy takes credit for it. But you know, I mean, supply and demand. There are a lot of different models. You know, some are better than others. The great thing about the current environment, sort of in the best instance, the best sort of accelerators are actually, giving you some resources to help you launch your venture, and by leveraging a pool of talent, a lot of other high energy entrepreneurs, maybe you can get things done faster, better, cheaper than you could otherwise. Maybe it's worth a few points of equity. It's the hardest thing. The hardest thing is in all of these is good talent with good experience, and so that's the question. I mean, I think in the olden days there were incubators that were set up as economic development agencies in corners of the world, and they tended not to have all that much value, and it tended to be, sort of office space and a copier. But in the sort of the new model, you're seeing more serial entrepreneurs who are giving back, who are actively involved in not taking, heinous percentages of your company, and, in some cases actually investing. And so, yeah, I think it's supply and demand. If you find some good resources and the price is fair, go in with your eyes open, ask advice. And it's a way to get your company launched.
Great. I wanted to allot some time for Q&A, because I'm sure there are people in the audience here who would love to ask you guys some questions. I've got plenty of other ones, but let's see what folks out in the house have to say. We have mics, Chris, is that right? All right, well, I'll keep faking it then until, or if anybody wants to just hold up a hand and holler from the back room, it's a small enough room. I'm not going to stand on ceremony. Mm-hmm. Okay, Chris is.
What do you think is
the impact of AngelList? A gentleman in the back with an Australian accent wants to know.
Yeah, I mean, it's it's certainly gotten a lot of visibility. It's an interesting phenomenon because it has been done, time and time and time again. There have been things like AngelList, that have percolated up over the last 12, 15 years. And interestingly, this time AngelList, the AngelList version of AngelList, has taken off. I think it's part of the feeding frenzy. I worry a little bit that it's part of the sort of disproportionate focus over on Web 2.0. And I have to be honest, I do not scan it religiously, and so in terms of the proportion of companies that are getting traction there, my understanding is that it tends to be the consumer web companies. If you've got a novel technology in material science, my understanding is you're not likely to get a lot of pings on AngelList, but maybe I'm wrong. But again, the whole idea that the broader question is the entrepreneur funding world becoming broader and deeper across sectors and across categories of investors? And anything that broadens and deepens the capital markets for funding entrepreneurship and innovation is a great thing. And if AngelList is broadening and deepening access to capital for startups, then it's a great thing.
Yeah, I fully agree. The more sources of funding, the better. As to paraphrase, I thought it was Chairman Mao, but apparently it's Guy Kawasaki. The 1,000 flowers or million flowers bloom. The more flowers that bloom at early stage, the better. And the best companies will make it through to venture stage where some serious funding goes in. And from our point of view, as a very active investor at all stages, seed, venture, and growth stage, the more sources of funding at every stage, the better. The more choices, the better. And particularly the very early stages, because it's going to give rise to a phenomenal amount of choice and a phenomenal amount of innovation. And the best companies will come out of that.
Yes, sir.
So in general, in the Valley right now, there's a talk of bubble, given LinkedIn went up to 122, and I think it's somewhere around 75 right now. And then obviously Groupon is going out, and then we're talking about Zynga going out. So what's your thought on these evaluations, and does it feel like it is back in 2000?
I'm going to repeat the question real quick for those in the back who might not have heard. It's a question about the valuation bubble that we're seeing in consumer internet plays like LinkedIn and Groupon and Zynga. And I know, if I haven't spoken to both of you, that you have thoughts about this.
Well, God bless bubbles, right? Remember the last time after the bubble burst, we all had bumper stickers that said, "Please God, let there be one more bubble," right? This time I'll know what to do, right? Well, no, I mean, and there can be arguments about it. I mean, the difference this time, I think, is I distinguish between good bubbles and bad bubbles. And the last bubble was a bad bubble because it affected the entire U.S. economy. This bubble, what's cool about this bubble is that NASDAQ is still at wherever it is. I don't know, 2,400? Where's NASDAQ? But NASDAQ is still at a fraction of where it was in the last bubble. And so to the extent that individual companies get way overvalued, what that means is you're going to have disproportionate cash flowing into successful entrepreneurs who, hopefully, given the patterns in the past, those people are going to recycle it into their respective venture communities. And so I love it that we're having all these LinkedIn millionaires. We already have a bunch of Facebook and Groupon millionaires, even though they haven't gone public. And so everybody presumes that those prices, those individual stocks, are going to come crashing down. But to the extent that we wind up not damaging the economy, but sending more money into the innovation ecosystem, I just love it. I think it's great.
John?
I agree. Having been here for the last bubble, as many of you were, I'm sure, to me, this is not 99. This is 96, 97 at latest. And with some major differences, as Bill said. I mean, we're talking about a gigantic market now. And when we saw the first bubble, there were companies going public with no business model, no revenues, and no market. And there were probably, if you go back, 11, 12 years now, there were maybe 100 people on the internet worldwide. They were using dial-up internet. We thought 56 kilobits per second was the bee's knees at the time. That's laughable now, right? There were no smartphones. Now you got 2 billion people on the internet. It's going to go to 4 billion with smartphones. So a massive addressable market and massive improvements in technology. So going back to Loud Cloud, when we tried to do cloud computing back in 2001, to host a website at that time, to run, manage, and host a website was about $150,000 a month. It was insanely expensive because you had dedicated hardware, very expensive software, no open source, dedicated data centers, etc. Now, a comparable, an equivalent website is probably $1,500 a month. I mean, it's literally been a tenfold change there, and sorry, a hundredfold change, and so enormous improvements. I would argue, and we would argue certainly, we're actually in a boom, and we're in. If you look at technology cycles, they've so far, and we only have limited history, but so far, if you think about shift from mainframe to distributed computing, or client server, or internet, or anything else, these big waves take 20 to 25 years, and we're in about the year 15, 16 of the internet wave. So, and the most value is created in the last 10 years, typically. So, if you look back at any of those cycles. So, arguably, we think there's strong fundamentals here that argue we're still in the last 10 years, entering the last 10 years of a significant boom before the next wave takes place. Now, there will be a bubble, very likely, at some stage, but we don't think we're in it yet. And LinkedIn is one company. It's the first of many. So there's a lot of scarcity. The public markets have been starved. It's an extremely small float. Can't even borrow shares to short it yet. I mean, there's a whole bunch of reasons why it's traded very high, and I don't think it's indicative of a bubble. And finally, as Bill said, public market valuations are very modest. Apple is arguably incredibly undervalued right now. You could argue Google is extremely undervalued as well, just looking at the PEs. So there's very limited signs so far to say there's a bubble, and I think we'd argue it's a boom.
There was a question over here. Somebody had a hand up about that. No? Going once, going? Oh, okay, a similar question. Other sectors of the room? I was going to follow up on that, but I wanted to make sure I wasn't doing the last couple minutes we have left, I wasn't cheating anybody else of an opportunity. Seeing none. So what things can be done to make this bubble that we are heading into end better than the last bubble?
Well, what things can we do? I think in part you're going to get, I think even though a lot of history suggests we don't learn from history, the pattern we're seeing right now suggests that at least there's some learning from history. The other thing is there's just huge sand in the gears of the markets right now that we didn't have in the last bubble, that are holding the markets back. I mean, I think to John's point, with so many other things going on in the U.S. economy and the global economy, you're not seeing all stocks rise in this irrational exuberance. Nobody would suggest that there is any breadth of irrational exuberance in this particular bubble. There's a very narrow irrational exuberance around some companies, and so I don't think we have to worry about, trying to throw brakes on or anything like that to adjust for this particular bubble. I think what I'm hoping for is that all these guys that are getting these extraordinary valuations are going to cash out quickly and reinvest in the venture world. That's kind of what I'm hoping for. We'll see if that happens.
Right. Bill Gurley was quoted recently in the paper on this question, and he said basically, it's all great unless you're the last one standing when the music stops. John, any thoughts that you would? I know you get this question all the time. So, how do you see this all coming to a close? And is there a way we can have a softer landing than we did the last time out?
Well, there's probably nothing any of us can do in this room to fundamentally change human psychology, and that's what drives bubbles. So I don't think it's entirely controllable. I do think from the point of view of investors, we have a responsibility to invest in ideas that actually make fundamental sense, and that do have a fundamental economic model that will work at scale and justify the amounts of money and the valuations that are being attributed. I think where the internet bubble really materialized and became a very significant problem for the last people standing was where a tremendous amount of companies got funded that had no economic rationale or no fundamental business model or addressable market that could possibly justify the valuations that they were funded at, let alone traded up to. And so I think as investors we can at least apply discipline there, and I think we're certainly trying to. We fund about 1% on the growth side, the late stage side. These are companies that are mature. We've just done the numbers because we have our limited partner meeting tomorrow. And by the way, not all limited partners hate venture firms. Ours seem to like us so far, but it is early days. We've just run the numbers. We've looked at hundreds of investments on the late stage growth side, which are attracting these large valuations, relatively speaking, and we've funded about 1% of them. So you need to be very discriminating as an investor. And I think that's where the responsibility of investors comes in. That'll help us to at least avoid the bubble being as severe as it might otherwise have been. But fundamentally, human psychology loves bubbles.
The one other factor that is different that does affect the way things sort out is that a lot of these companies are going to wind up not going public but getting acquired. And so you have, in sort of great example, right, Skype winding up getting acquired by our dear friends here at Microsoft. Whether you think that was overvalued or not, likely, I mean, there's all sorts of different leverage that a company like Microsoft can apply to Skype, and Skype can apply as a standalone company. And to the extent that great technologies and companies get very exciting valuations and get taken over by corporations with vast amounts of cash, that's a different path. And you don't have the same last man standing sort of NASDAQ bubble popping problem that you had in the last bubble.
Great. Bill Reichert, Garage Technology Ventures. John O'Farrell. I wanted to say John O'Flaherty. I knew I wasn't right, so I looked at my notes.
That's right.
Oh, yeah, right there. John O'Farrell at Andreessen Horowitz, A16Z, as they're known in the business. Thank you both. And Jeff Clavier, uncharacteristically quiet today for Jeff. But
some of the most cogent remarks today.
Exactly. Sometimes you say the most by saying the least.
Yes,
right?
exactly.
Thank you all very much. Enjoy the day.